In this video, we're going to expose just how legacy car dealerships make money on the back end of the deal. I'm Josh West, and this is Josh West 24/7. I'm a 15-year veteran of Legacy Automotive and a top performer in the industry. But now I see the dealership network is absolutely obsolete, and I'd love to show you why. There are so many different profit streams for the back end of the deal with Legacy Automotive Dealerships. And when I say the back end of the deal, what I'm referring to is the business office or the F&I department. You know that office that you go to after you've bought the car from the salesperson, that nice person that you sit down with and talk about the numbers, the financing, the lease, do your credit application, and then they go ahead and try and sell you a few things? Yeah, that's exactly what I'm talking about. So I've broken it down into several different categories, 3 to be exact, and I might have a little bonus for you at the end. So first up, we've got products sold by the dealership. We'll begin with my favorite, rust proofing. Rust proofing and undercoating is something that's more popular in the northern US and across Canada because our roads are salty and the winter really has a hard effect on vehicles. And rust proofing and undercoating just puts a coating of product underneath the car to try and stop it from rusting over time. And generally it's sold with some sort of guarantee or warranty and that sort of thing. The problem is not so much with the product itself, but rather the premium that is charged for it. You see, what happens is because you're buying it at the dealership level, they'll charge exorbitant amounts for it. Meaning that if you were to go to an aftermarket shop, they might charge you a few $100s, but from the dealership, they're charging several $1,000s. Are you getting more coverage? Well, that's for you to decide. Drop it in the comments below. Would you go to an aftermarket company, or do you think it's worth more to pay the dealership to apply a similar product? Now, of course, the dealerships will claim that they have phenomenal warranty coverages, that if you purchase the vehicle and pay 10x to them, then of course your vehicle will be more covered and secure and so on. Well, the problem comes that when you read the fine print of those warranties, there are limits as to the dollar amount of repairs that the warranty will even cover. And oftentimes the customers are paying more than the dollar limits of what their vehicle is even covered for. Is that a good deal? I don't know. Tell me in the comments. Next up, we've got accessories. Well, you've just purchased your vehicle, so now don't you want to protect it? Of course you do. Don't you want to buy a bug guard that you could go to a third-party aftermarket company and buy it for $400? But why not just wrap it into your finance payments for $1,000 or $800? Why not? It just adds a couple of dollars to your payment, right? Great profit revenue stream. Another avenue for profit is actually one that we touched on in my previous video when I talked about profits in the front end of the deal. This is a tactic that's used in a slightly different way based on manipulation of interest rates in financing. And I'll give you a scenario. So let's say you've purchased a vehicle and that deal, unbeknownst to you, was worked at a specific interest rate. Let's call it 7.9% or whatever the case may be. You go into the business office or the finance office and you sit down with them and you're talking about all the coverages and all that different sort of thing. But you decide, you know what, I'm just going to buy the vehicle and, my payment is, $300 biweekly. I just want it to stay there. I don't need to buy any extra options or accessories or coverages or things like that. Okay, fine. So you leave and you wait for that call to hear that your financing has been approved. The business manager submits it and turns out, geez, your credit's better than what you thought. Or maybe they got a special rate at the bank, or maybe a bank came out with some sort of promotion, or maybe they make it a special phone call, or whatever the case may be. They get you a lower interest rate. Let's say you, instead of 6.9 or 7.9%, they got you 4.9%. Well, that saves you several $1,000s on your interest costs. So what do? Do they call you up and say, hey, great news, Mr. Customer, we were able to lower your payment by $100 or $50, whatever the case may be? No, what they do is they go into your deal that you had a trade in there, and let's say your trade you were given $10,000 for, and the ACV or actual cash value of that trade is also $10,000. You put the deal together and so on. So what they do is the interest cost that you would have saved, let's say is $3,000, they drop the trade down to $7,000 and reroute internally that profit straight to the back end of the deal, of which that business manager will be paid a commission on, and the remainder goes directly into the pocket of the Legacy Auto dealership. Great deal. Next up, we've got third-party products, and boy, there is a lot of them. You know what? I probably missed a few, so whichever ones I missed, guys, throw it in the comments below and remind me how many I overlooked. First up, we've got insurances, and we can debate for days of whether or not they're good products, bad products, whether you need them, what reasoning you buy them for, or if you just bought them out of fear or pressure or whatever the case may be, but they're a product nonetheless that's sold through the business office. You've got life insurance and disability insurance. And the bottom line is maybe you would have bought them, maybe you wouldn't have. Maybe it wouldn't have affected your purchase at all. Next up is rim and tire protection and key loss programs, meaning that if you lose your key fob, they'll cover the replacement. Same with the rim and tire. So if you get a damage in your tire or you scuff a rim, they're going to repair it or replace it or whatever the case may be. The problem comes again with not the actual coverages so much as the premiums that are charged for these programs. You see, dealers are in it only if they're making big money. Otherwise, they wouldn't waste their time selling you these programs to make $20 or $30. They want to make hundreds, possibly even thousands of dollars on each and every one of these programs. Oftentimes, the payout on these programs is less than the premium being charged, meaning that you paid more to cover your wheels than they'll ever pay out to replace or repair them over the entire course of the warranty. Can you imagine that? Most of you have heard of nitrogen being added to your tires, but have you heard of hydrophobic glass treatments such as Aquapel, basically adding Rain-X to your windshield for hundreds of dollars? Fantastic. Fantastic for the dealer. Huge profit center and basically no overhead. Another third-party product that's sold to you in the business office is paint protection. It'll be sold to you as a special product that will help rejuvenate your paint, make it looking newer, longer. It'll cause water beads to just drop right off the car. Essentially something that you can get done at any detailing shop. Most of the time, those products are even better than what the dealership would sell you because, of course, the dealership is highly focused on generating profit. Arguably, one of the biggest profit generators in the back end of the deal are extended warranties. Now, some of these warranties are backed by the original equipment manufacturer, the people that made the car, and those have some legitimacy to them. Some of the other warranties are complete garbage when they come from third-party companies. They will not cover certain components. They'll have enormous amounts of fine print. But the biggest point I want to make with warranties is the price that you're being charged up front. The premium cost, again, oftentimes is the same or more than what will even be paid out on the warranty. Specifically referring to third-party warranties, again, there is always exceptions, but this is a massive profit center for the back end of the deal. But I promised you a little something extra. That something extra, I'm going to call it financing games, and I'm going to get into some of the nitty-gritty details here. Unfortunately, there's some shady practices that go on in the finance office at these legacy automotive dealerships. You see, they have one goal in mind, and that's to roll a vehicle with the absolute most amount of profit that they possibly can, with absolutely no concern for that customer should they ever come back. They would rather work harder to get a new customer, a new lamb to the slaughter, rather than try and retain their old customers. First up is a very unfortunate practice that is all too prevalent in legacy automotive finance offices, and that is fudging credit applications. There's multiple reasons why credit applications would be modified. I'll give you one good example. If there's a huge amount of profit in the deal, the dealership or the business office manager will take a look at the deal and think, well, is it worth it to risk? Yeah, it is. So I'm just going to up his income. I'm going to adjust his debts. I'm going to make a few adjustments because I know how to game the system and get that approval. And sure enough, they do it. Customers happy they got the car. Should they have had the car? Well, you tell me. Comment down below. If a customer shouldn't have been approved for a deal, does that mean that it's a good thing that they got approved for the car and took it? Next up is a little thing I like to call bribes and buddies. And what I'm referring to is the relationship between the lender reps, the representative of the lenders, and the business office managers. They get to be a little buddy-buddy, spending so much time together, sending through so many applications and getting so many loans run through. And remember that the finance reps have targets to hit as well. They have incentives and they have goals to achieve. Those goals generally involve pushing through the most amount of dollars financed to generate the most amount of interest, which is profit for those lenders. Now, with these unique relationships, oftentimes what can happen is when a dealer has a really big deal, I mean really juicy, meaning that they got the customer to take all the extra fees and all the extra accessories and they've got all the profit that they could possibly jam into that deal, but the deal's coming back as declined. And so what do? They pick up the phone and call their buddy at the lending office and leverage their relationship to make that deal get approved. How do they do it? Who knows? Is it right? Who knows? But it's up to the lenders at the end of the day. And so they call in a favor. And of course, there's never any sort of gifts or reciprocity or anything like that. Absolutely no sports tickets or gift cards involved whatsoever. It's all above board. obviously. Now, there's a fundamental flaw with the way that the finance and business office is set up. You see, the banks make money off the interest of a loan. And there's three ways to generate more interest or more revenue, more profit for the lender on a loan. One is to finance more money. Two is to extend the term of the loan. And three is to increase the rate. Now, the finance office pays a commission to the business manager at that dealership based on the amount of interest that's being generated from the loan. So basically, the way that it works is that the dealership will make more money if they push their customer into a longer term loan at a higher interest rate on a more expensive vehicle. You can see where there's a little bit of a conflict of interest, I'm sure. Regardless of whether or not this is in the customer's best interest or not, the dealership is focused on one thing and one thing only, and that thing is profits. One of the other games that can be played in a finance office is something called a rate buy-down amortization. And I'll give you a quick rundown on the way it works. We're going to get into the weeds a little bit here, so try your best to follow along. Now, the way this works is very similar to a mortgage. Instead of doing a traditional, let's say 96-month or 8-year finance, what they'll do is they'll adjust the customer's payment program to be amortized over 96 months rather than financed over the complete 96. They'll do the finance term at, let's say, 12 or 18 or 24 months, a much shorter period. And let's say in theory that over that 8 years, if they had done a traditional finance, the interest cost would have been, let's say, $8,000 or $1,000 a year. So in theory, it would mean that 2 years of interest cost would be approximately $2,000. So what they'll do is they'll buy that interest rate down to 0% for the first 2 years. And all it'll really cost is $2,000 in theory. So what the dealer representative does is sells the customer $6,000 worth of extra add-on products filled with profit, and then buries the remaining $2,000 in there as well. The customer thinks that they've got 0% financing for 8 years, when in actual fact, at the end of the 12 or 18 or 24 months, they're in for a rude awakening. They're going to get a letter from the bank saying, hey, it's time to refinance the remainder of your loan. And the customers, of course, are freaking out saying, well, I thought I was supposed to have 0% for the entire 96 months. But in actual fact, that was not the case. What's even worse is that they ended up financing an extra, in our example, $6,000, $7,000, $8,000 over and above what they had originally. So at the end of that 2-year period, they now owe more than what they would have if they had taken the original finance program. And of course, they're upset, but one of three things happens. One is they never buy a car from that dealership again. They freak out at the bank, but they end up going ahead and refinancing and paying the higher interest rate. The second thing that happens is they trade that vehicle in and buy another car somewhere else. And the third thing that happens is they freak out, they go back to the original dealership, and that dealer fudges and plays around with some numbers, jams them into a new finance program that's a traditional finance, and maybe eats some of the cost or the difference, but the reality is the deal would never be as good as what they could have originally agreed to over the full 96 months. So these are some of the nonsense games that are played by the finance departments. There's a lot more that I haven't even gotten into. So we've gone over so many profit streams for legacy automotive dealerships. We've talked about products that the dealership offers, such as rust proofing and undercoating. We've talked about third-party products, such as extended warranties and glass treatments. And we've talked about financing fees, and we even touched on some of the games that are played in the finance office. Now, let me bring this full circle for you. Legacy automotive dealerships look for any possible way to create profit for themselves. The problem is that this is completely counterproductive to the manufacturer. Every dollar that the dealership adds to the price of the vehicle burdens the customer financially. Therefore, they can't buy as nice of a vehicle, they can't trade in that vehicle as often, and they may think that the vehicle is too expensive and next time buy another brand. Many legacy automotive manufacturers realize this, such as Ford Motor Company, and are right now making drastic moves to dissolve their dealer network and move to a direct-to-consumer business model. I hope these insights into the back end or the finance world of legacy automotive dealerships has been enlightening for you. I've got a ton more juicy details on legacy automotive. We'll see you in the next video.